One of the major economic forces in any economy is the government. The government influences the economy through two types of policies: fiscal policy and monetary policy. Monetary policy deals with issues around the supply of money. Fiscal policy deals with the issues of the government's spending policies and taxing policies. This video reviews the basic structure of the U.S. government, especially how it deals related to spending and taxation policies. The video will also provide some background on the role of taxes in a modern economy, as well as the impact of taxes on government revenue. The video will deal with situations when the government overspends or underspends. The U.S. government is divided up into three parts: the executive branch, which is the president, the vice presidents, and the various departments, for example, the Department of Defense; the legislative branch, the U.S. Congress, which is divided up into the House of Representatives and the U.S. Senate. Finally, the judicial branch, the courts of the United States, headed by the Supreme Court. The job of the executive branch is to carry out and enforce the laws passed by Congress. The executive branch has no power to tax or to spend without the approval of Congress. Indeed, the President must request money from the Congress in order to operate the federal government. The President is assisted in making requests for money by the Office of Management and Budget. The President has the right to refuse to sign off on a budget presented to him or her. This refusal is called a veto. Budgets run from October 1st to September 30th. The role of the legislative branch is to pass laws for the entire country. The Congress has the power of the purse, meaning it alone has the power to tax and to spend. The Congress gets this right from Section 7 of the Constitution. Section 7 explicitly states that the House of Representatives is responsible for initiating or creating spending bills. The Congress must pass a bill in order to fund the U.S. government. The Congress is assisted in creating budgets through the Congressional Office of Management and Budget. The role of the judicial branch is to administer justice and arbitrate between the executive branch and the legislative branch. Courts rarely get involved in the appropriation of money, but they do have a role in making sure that spending and taxation bills are constitutional. For example, in the 1930s, Congress created and funded a bill called the National Recovery Act. However, the Supreme Court ruled that the National Recovery Act was unconstitutional and thus voided the law, despite the fact that Congress wanted the bill and was willing to appropriate money for it. The process of putting a budget together works something like this. The President requests federal agencies like the Department of Defense to put together a budget. Federal agencies submit their requests to the Office of Management and Budget. The Office of Management and Budget looks at the requests and decides whether or not these budgets are realistic and makes their recommendations to the President. The President takes these recommendations and passes them on to Congress, as well as to the Congressional Office of Budget and Management. The Congressional Office of Budget and Management analyzes the budgets and submits their recommendations to the various budget committees of the Congress. The budget committees of Congress will pass on their views and their budgets to all committees and to the Congress. The Congress will then vote on the budget, and then if the President agrees to the budget, then that spending will occur. There are two types of fiscal policy that the government can carry out. First off, they can be expansionary fiscal policies. This means that the government action is something that will lead to an increase in aggregate demand. The government may also engage in contractionary fiscal policies, which lead to a decrease in aggregate demand. Both types of fiscal policies are designed to move the economy closer to full employment. If the government acts properly, then the policy will help the economy. Otherwise, it will hurt the economy. There are two types of government spending: discretionary fiscal policies. Congress authorizes these policies on an annual basis. Discretionary fiscal policies change government spending and taxation achieving specific policy goals. Automatic stabilizers are spending that has been authorized in previous long-term laws, such as Social Security. Automatic stabilizers are an element of fiscal policy that changes as income changes, and thus are called automatic stabilizers. As you remember, the business cycle is the fluctuations or changes in GDP. You may also remember that the point where the GDP is highest is called its peak, and at its lowest is called its trough. The idea behind automatic stabilizers is to limit the peaks and the troughs. So peaks are not as high and troughs are not as low. The idea here, once again, is to moderate the destabilizing effects of extreme prosperity and extreme poverty. Fiscal tools of the nation consist of the government's spending policy, the government's taxation policy. So let's take a minute and look at some taxes. Taxes are a fact of life. In fact, Benjamin Franklin is reputed to have said that there is nothing certain in life but death and taxes. So let's take a look at different types of taxes. The government can obtain its money to spend by one of two ways. First, through taxation, which is the collection of money from the private sector, that is from firms and individuals. The thing to remember about taxation is that it does reduce consumptions because individuals and firms have less money to spend on other goods and services. The government can also obtain money by borrowing. That is, the government can sell bonds or IOUs to investors. There are four reasons governments impose taxes. First, to generate revenue to support government services. 2, to redistribute wealth from the rich to the poor, usually. The third reason for taxes is to reprice goods and services to make them more expensive, causing the demand for them to shift to the left. The best example of this use of taxation is cigarettes. The government taxes cigarettes in order to discourage individuals from smoking. The fourth reason for taxes is it gives us the right to political representation. Indeed, the chief reason the American colonies revolted against the British Crown was not that so much they disliked George III, but he and the British Parliament taxed American colonies but offered them no say in the process of formulating these taxes that were paid by the American colonists. Thus, the cry of the American colonists was no taxation without representation. There are several types of taxes. The first type of tax is an indirect tax, where the characteristics of the individuals paying the tax don't influence the amount that is paid. Sales taxes are an example of indirect taxes. Another type of tax is a direct tax, which different individuals pay different amounts because of some difference in their personal characteristics. Income tax are examples of direct taxes. Let's look at a couple of examples. Colleen earns $15,000 a year and she buys a DVD of her favorite movie for $15 and pays 90 cents in sales tax to the store. Frank earns $250,000 a year and he buys a DVD of his favorite movie for $15 and pays 90 cents in sales tax. What type of tax is the sales tax? The tax is an indirect tax because both Colleen and Frank pay the same amount of tax on the DVD regardless of the fact that Colleen earns $15,000 and Frank earns $250,000. Let's look at another example. Colleen earns $15,000 a year. She pays $300 in income tax. Frank earns $250,000 a year and he pays $50,000 in taxes. What type of tax is the income tax? The tax is a direct tax because both Colleen and Frank pay different amounts depending on their income. Let's take a minute and look at some more different types of taxes. Regressive taxes are taxes where the tax rate increases as an individual's ability to pay decreases. That is, the rich pay less and the rich pay more in taxes. Progressive taxes are taxes whose rate increases as the individual's ability to pay increases. The rich pay higher taxes and the poor pay lower taxes. Proportional taxes are those taxes where the rate is the same for both income groups regardless of their income. The rich pay and the poor pay the same tax rate. Let's look at another example. Colleen earns $15,000 a year and she pays 2% of her earnings in income tax. Janet earns $30,000 a year and she pays 11% of her earnings in income tax. Frank earns $60,000 a year and he pays 20% of his earnings in income tax. What type of tax is the income tax? It is a progressive tax because the rate that individuals pay increases with their income. Who benefits from this type of tax? Colleen does, because she pays the lowest tax rate. Colleen earns $15,000 a year and she pays 10% of her earnings in income tax. Janet earns $30,000 a year and she pays 10% of her earnings in income taxes. Frank earns $60,000 a year and he pays 10% of his earnings in income tax. What type of tax is this income tax? It's proportional because everyone pays the same rate as everyone else. Who benefits from this tax? Frank benefits the most from this tax because he's least likely to hurt his lifestyle by paying it. Let's look at another example. Colleen earns $15,000 a year and her state charges her $750 to register her car each year. Janet earns $30,000 and her state charges her $750 to register her car each year. Frank earns $60,000 and his state charges him $750 to register his car each year. What type of tax is the registration fee and who benefits from this type of tax? The table summarizes the three individuals we're talking about, their income, and the effective tax rate. Let's go through and analyze the effective tax rate for each of our taxpayers. Colleen is paying an effective tax of 5%. Janet is paying an effective tax rate of 2.5%. Frank is paying an effective tax rate of 1.25%. The thing to notice here is that as the person's income increases, the tax rate decreases. So let's go back to our problem where Colleen earns $15,000 and her state charges $750 to register her car each year. Janet earns $30,000 and her state charges her $750 to register her car each year. Frank earns $60,000 and his state charges him $750 to register his car each year. So the type of tax, the registration fee, is a regressive one because Colleen is paying a higher tax rate than either Janet or Frank. Who benefits from this type of tax? Both Janet and Frank, because they are paying a relatively low rate despite the fact they earn more money. There are other kinds of taxes: consumptive taxes, income taxes, wealth taxes, and corporate taxes. Consumptive taxes are those taxes that are paid on consumption. This would include fees like the cost of obtaining a driver's license or a registration fee. Income taxes are taxes that are paid on income. Wealth taxes are those that are paid on wealth. Corporate taxes are paid part of a company's doing business. There are two problems related to taxation. First off, excessive taxation can lead to an increase in the underground economy. Excessive taxation can also lead to individuals not working as hard, especially in terms of income. And in any case, excessive taxation leads to inefficiency and underrepresentation of GDP. Art Laffer, an economist formerly of the University of Chicago and currently working in the private sector, developed the idea that increases in the tax rate lead eventually to decreases in government tax revenues. Let's see what Laffer was thinking. Suppose the tax rate is 0%. Then according to Laffer, the government revenue should be 0. Next, if the tax rate increases to T1, the government revenue should increase. When the government increases the tax rate to T2, government revenues continue to increase. When the government raises the tax rate to T3, the government revenues continue to increase. When the government raises the tax level to T4, the government revenues still continue to increase. When the government raises its taxes to T5, Laffer argued that perhaps the government revenue would decrease because some individuals might find it beneficial to themselves to work less, or they might begin to work in the underground economy. So, therefore, tax revenues would decline. Suppose that the tax rate continued to increase to T6. Once again, the government revenue would decline even further because more individuals would find it less beneficial to work or to work in the formal economy. When the government raised tax rates to T7, still more individuals would decide not to work as much, or they might choose to work even more in the informal or the underground economy. When the tax rate reached 100%, government revenue would fall to 0. So, the point Laffer was trying to make is that if the government increases tax too much, then individuals will pay nothing, and the government will receive no revenue. Government can borrow money to fund its activities and to find extra expenditures to stimulate the economy. So we need to understand some of the terminology connected with borrowing money. First, a budget surplus occurs when the amount of taxes collected by the government exceeds the spending by the government in a given year. A budget deficit occurs when the amount of spending by government exceeds the amount of taxes collected in a given year. Government debt is the total amount of money the government owes its creditors, or the sum of deficits. Some problems associated with government borrowing. First, borrowed money must be repaid with taxes. So therefore, borrowing money really is a tax increase. This is known as Ricardian equivalence. Secondly, government may crowd out private borrowing by bidding up the interest rate. Let's take a minute to look at crowding out in sort of an intuitive way. The term crowding out means that the government borrowing will cause investors to choose to lend money to the government instead of the private sector. How might the government get investors to make loans to it instead of firms? The principal way the government can encourage individuals to invest in government bonds is to increase the interest rate it pays to the owners of the bond. So, government might offer 15% interest instead of 3% interest. However, the government will have to pay individuals back $115 for every $100 they borrow, instead of paying back $103 for every $100 they borrow. Where does the government going to get that extra $12? It will do it by raising taxes. Government might also appeal to patriotism, social pressure, and other incentives. The government also may mandate by law that everyone purchase government bonds or face some type of financial penalty if they fail to do so. Deficits may cause interest rates to increase and thus may depress investments. Deficits will cause an inflow of foreign currency into the United States. So increases in deficit encourage foreign investors to buy U.S. government bonds, causing foreigners to demand more U.S. dollars. As the demand for U.S. dollars increases, it causes the value of the U.S. dollar to increase in value. Thus, foreign goods become cheaper and U.S. goods become more expensive. The final approach for the government to increase the expenditures to boost the economy is to simply print more money. This, however, will lead to inflation, hyperinflation, and will lead to long-term problems with savings and investment.